I did not see you change. Welcome everyone to, I guess this is the OSV podcast now.
I'm a sponsored athlete now. I don't know what to tell you. I'm just a sponsored athlete.
Wow.
Oh, what's that, Corey? I can't hear you. Let me take a sip of my water bottle here.
Wow, you didn't even get me any of that drip. Look at that. We really got to step up our pirate game.
I think Jim just likes me more than he likes you. I mean, that
is true. That's unquestionable. Well, welcome everyone to the Pirates of Finance, the show that has been described as finance bros doing a completely scuffed podcast about finance, rarely talking about finance. Shout out to 686 Ebullient Prism on Twitter for that absolutely perfect description of what we're trying to achieve here. We are the host of the podcast. The handsome gentleman across the mic from me is Jason Buck, aka the Young Hemingway. My name is Corey Hofstein. Nothing you see or hear on this show is financial advice. But given that we don't actually talk about finance, I feel like I don't even have to have that disclaimer anymore, Jason.
Exactly.
Speaking of shows, I want to start off talking about maybe the best podcast we ever recorded. I would argue it's actually the best podcast that's ever been recorded of all time. Yeah, last week, you and I sat down in Miami after a long week of, actually a long half week for me. You were in a week and a half of conferencing. We sat down outside in some nice chairs. We tasted rum together. We talked conference hacks. We laughed. I cried. It was a perfect episode. And true to form, turns out my microphone was popping the entire time and none of it's usable.
Not popping, like just full distortion. Like it's completely unsavable.
Yeah, completely unsavable. And the sad reality is that will never see the light of day, and nothing we do will ever live up to it again. I mean, the best we could do is a mere tribute episode, and even that, I'm fearful will just be so substandard. It's just sad.
Well, my favorite part of it is like, and why we both think maybe it was the greatest is we were both chilled out. We were sitting on lounge chairs on a patio at the Standard Hotel, both in sunglasses, tasting and drinking our latest rum samples. I think you called me the Unabomber at one point. But yes. It was definitely a very casual episode of us tasting and discussing our latest rum samples and what we thought, but then also giving our best hacks for managing these investment conventions or conferences and how to get through these kind of events. So, that's kind of what everybody's missing.
We did a whole draft of what we'd bring in our bags, top 5 things for the conference. You had some pretty wacky choices. Maybe we'll bring that back someday. Next big conference circuit, we'll bring that back. But so that was pretty sad. It actually made it hard to come on this episode, knowing that we've hit the peak. And every subsequent episode will just be falling down the other side of the mountain.
Yeah, how boring are we now? Like in studio, so to speak, not even in person, not drinking, allegedly. I don't know if you're actually drinking or not at this point.
Yeah,
Exactly. Let me take another sip of my handy water bottle here. Just
I feel like you're selling out for another team here. Like this is your way of telling me you've been traded to another podcast.
What's sad is how cheaply I can be bought, right? Like just maybe I don't even know, like $100 or a little bit more in swag, and I'm just gonna wrap it on a podcast like a.
That's right.
Yeah,
that's right. Okay.
You want me topics or you got a topic?
You can go ahead. I always take up too much time on this show. I want to hear from you, Jason.
All right. So huge fan of the show, Med Faber. Had on his podcast this week the illustrious Corey Hofstein and Lee Drogan. And I'm going to use Corey Hofstein in bright lights and Lee Drogan in small subprint, 8 font. You're welcome, Lee. I'm sure he'll come at me for that one. But anyway, I'm going to start right away from the top of the podcast. I know it was recorded a while back, I'm sure, because I know how Meb's podcasts work. Because he has a very diligent schedule and he's well prepared and his team does a great job, unlike you and I. And first of all, how come we never privately talked about Whitefish, Montana? Did you really love Montana? Like, where was I not included in this discussion? I I'm not even sure I knew you went to Montana, other than you being stuck in airports for 48 hours at a time. How was
remember one of those weeks that we had to pre-record because I couldn't be there on a Friday? I was in Montana. Yeah, man, I love Montana. I love Whitefish. It is a tiny little town on a lake that's like a 7-mile by 3-mile lake, which to me is like the perfect size lake. This awesome little ski mountain that has side country and back country, but it's also super family friendly. They've got this bus that runs from the downtown for free that takes families up to the mountain. Like it's good skiing. It's family friendly skiing, but there's got tons of like, advanced terrain if that's what you're into. But it's just like it hasn't been overrun yet. It's you can see it's at that tipping point though. You can see there's like a little bit of potential conflict in the town between the haves and the have-nots, and the haves that are moving in and buying up all the nice property on the mountain. But it's not like it's Vail, Colorado, or Salt Lake City. Like, this is still very much a very sleepy town. I actually feel bad talking about it. I hope it stays sleepy because it's a very awesome town.
So did you try to convince your wife to move in there, or
I absolutely did. No. I said to my wife, if I stay here another day, I'm buying a house. And she said, great, buy one, which is what she always does. When I tell her to do something outrageous, she's just like, no, you absolutely should do it. And then when she gives me permission, I don't want to do it anymore.
Dude, that is my life too, so well. Like, all the time, my girlfriend's like, yeah, she's like, yeah, that sounds like a great idea. Just go do it. And I'm like, oh, this just yucks my yum, right? Like, we want the taboo of saying we can't do it. And then we're like, oh yeah, I'm gonna do it. I'm gonna show you. Like, they've got us nailed down.
I'm a mountain and lakes person. My wife is an absolute ocean person, and therefore we live in Florida. So you can see how my life goes.
Were you gonna say something else about Whitefish before I move on? I thought you were jumping in there about like
one of the very cool things about Montana that I learned is they have all these little like micro casinos. So the bar we went to hang out at, they had a live poker game going on that you could go sit down. There was like 7 people. There were a whole bunch of slot machines, but everyone else was just like hanging out drinking. It was sort of this weird like local bar, hyper local casino mix, and Lee was telling me that's just how it is in Montana. Like, they keep the casinos super small and super local, and like every town has their tiny little casinos. They don't allow online sports gambling, so you got to go like cross the border if you're gonna do that, which depending on where you live in Montana is a very far way. But this was up near Canada, like Lethbridge, Canada is probably the nearest town, which oddly enough I've been to. Why I was in Lethbridge, hawking product is a story for another day. But tons of Canadians who came over the border to go skiing. It's just a great little town.
Yeah, I think Lee tweeted today that he's going up to Calgary to watch the Rangers game, and I'm like, it just makes you forget like how close he potentially. I mean, I think it's still a long drive, but like at least he's close to the Canadian border.
He moved out there full time. I think he. I mean, during COVID, decided he was going to do the move west young man type situation. Ended up finding a property he loved. Moved full time, I think, in mid 2020, and hasn't been like got rid of his place in New York. So he was one of those left New York and never came back, and I can totally understand why. Now, having been to Whitefish, Montana,
it definitely suits him. And by the way, how great of a name is Whitefish, Montana? Is there a better name for a town than Whitefish?
I know. Well, so Whitefish, Montana, like Whitefish, Massachusetts wouldn't work. But when you're like Whitefish, Montana, you're like, that's good.
I actually want to. So there's some highlights from the pod I want to get to, but by the way, you strike me as somebody that doesn't watch Yellowstone.
No.
Yeah. So I was going to ask if you felt like
by
you
the
were
way,
living that Yellowstone life.
Tidbit.
You strike me as somebody that doesn't watch anything.
As someone who is currently trying to come up with a baby name, one of the things that I have my finger on the pulse of is baby name trends. Yellowstone is so popular that like old Western names are now coming back. So like Dutton, Wyatt, like all these Western names are now emerging. So in like 20 years, the workforce is going to be filled with a bunch of like Yellowstone rancher names.
Man, I was trying to get into at least some finance before we talked about baby names. It was like 6th on my list, but you just front ran my list again. I did like I like Tyler's suggestion of Banjo.
Banjo's a good one.
Somebody
I
else
like Toby
said,
Carlisle. Toby Carlisle
yeah,
told me I
wait,
should name my kid David Hassel. So David
dude,
Hasselhoffstein.
Hasselhoff.
I thought that was pretty good.
That one was awesome. I saw that one. And then was it Jim Carroll? I think that said like basically just have veto rights and let your wife
Yeah.
come up with a name or something like that. Was it Jim or
Yeah.
somebody else?
The thing I love about Twitter is I always forget that like you put something out there, it's like you're standing in this grand bazaar and you say something and you think like just your friends are around you. And then like just really random strangers just come up and like totally misinterpret your tweet. I had some people giving me like some very serious responses to what I thought was a very clear joke tweet. And they're like, no, you have to pick a baby name. Or like, bro, you're thinking about this too hard. I'm like, we have never interacted ever. Like, calm down.
Man, this reminds me so much. You remember how when you tried to tell me one time, you're like, no, I think people get my sense of humor through my tweets. And I just laughed hysterically. It's like, I don't think people see your sense of humor at all.
My tweet was about not naming my kid, naming it. Like, how do you not get that that's a joke? Which actually makes me genuinely concerned about people's perception of me.
Exactly. You should be concerned. It made me think about like, I almost got into those comments too of like, historically, we didn't know how long children were going to live. So a lot of times people didn't even name their kids right till they survived the first year. So I was going to go dark with it, but
don't put that voodoo on me, Ricky Bobby. All right. Well, we're talking about
I like Hasselhoffstein. Hasselhoffstein is fire.
If we're talking about tweets, I tweeted something today that was specifically aimed at pissing you off. And this is finance related, but this was specifically, I knew you would eventually see it. So one of the things I did is I went back to the 1970s and I plotted year over year inflation. And one of the really interesting things you see in the 70s when you look at CPI year over year is that you have these like three waves that get progressively bigger. So from the late 60s to the early 70s, mid 70s, and then finally late 70s. And it's like you hit that 6% and you come back down. And then you get up to like, I think 9 or 10%. And then you finally get that final wave up to like 15% year over year inflation. Right. We often talk about that period as if there was like very consistently high inflation, but from a year over year perspective, right, you really had these three waves. And so my tweet was, all right, someone give me a narrative as to what this was, right? Is it geopolitical? Is it economic? Is it, bullwhip effects? Was it misplayed policy? And this was just like, I don't know. This was like just the most delicious tweet for me because I knew for a fact it was going to invite the most strongly opinionated people who would completely disagree with each other as to what the cause was.
And once again,
what do you think, Jason? What do you think of my tweet?
People took you seriously once again. And no, yeah, you're right. It was a perfect tweet for me. By the way, it reminds me of like, I think we talked about before is like, if you don't think there's, secondary and tertiary waves to like the latest inflation we've seen or CPI numbers, if you want to call it inflation or not, is like, that's how things work. It comes in waves. But no, it was one of my favorites. Yeah. Watching all the explanatory variables is that, and like you brought up right before we got on, is like, even all these decades later, we still don't understand. So it highlights how we don't have and then in real time, we have no idea. And then because in 50 years time, we still have no idea, or people are still debating, why it comes. That's why I hate when people bring up Volcker, because the prior to the Fed president, they had tried the same thing. They tried, but it didn't work. Right. And then so like all of a sudden Volcker is like the man, like it's the great man theory. And it's like not thinking about, the different variable effects of society from a bottom up, like kind of emergent property. But no, you didn't make me mad because I saw what you were doing. And then I just looked through and
saw
just
right
laughing.
Through my game.
I saw right through it right away because I knew what you'd be doing. But I'm trying to also pull up the hero tweet of the day.
While you're doing that, I got to tell you, so the picture I showed, right, of these three impulse waves, as the proud father of a new managed future strategy, if I had lower ethical standards, I would use that picture like a madman for marketing. I would draw an arrow right to like where the 6% wave rolled over.
Exactly.
And I'd be like 20.
Here's where we are.
Mark. And I would just hammer unsophisticated investors with that message. And I would raise so much money.
So my hero tweet of the day was from I am Sean MCD. He said, "I pride myself in not trying to explain the unexplainable. I also have no effing clue in this specific case." And that's, I mean, come
Great
on,
response.
that was pure beauty. By the way, and
I'm actually
Rodrigo,
surprised you don't like print that and like have it on your
exactly.
wall as just something you can constantly repeat.
That should be my pinned tweet. But also, by the way, Rodrigo, shout out to Rodrigo's in the comments. But Rodrigo brought up how angry you made people about your Buffett tweet as well. So you want to bring that
Oh
up?
my God, I just I don't understand what's happening on my Twitter lately. So I was talking about replication strategies. Oh, we get a nice close up on Jason there. Thank you, Tyler.
No,
Talking about replication strategies. It's a little weird when we're changing these view. I don't even get to see Jason anymore. I'm just talking at myself. Talking about replication strategies and ways in which you can try to quantitatively replicate another manager's or strategy's returns. So this is something that we do and have done with hedge fund strategies. I feel like when you just jump into the deep end of replicating hedge fund strategies, people kind of get lost. So I wanted to use this example of, well, if you're replicating Warren Buffett's returns, how would you do that? And I really think there's two primary ways in which this is done. The first is to say, let's look at Warren Buffett's track record and try to identify the stocks and the weights of those stocks that would give you as close to a similar return profile as possible. Right. So figure out exactly what the holdings are, how much weight in each. And we call that a top-down approach. It's incredibly agnostic to how Warren Buffett picks stocks. It generally makes the assumption that, whatever he's holding, he's going to continue holding, at least for the short term. But, if Warren Buffett is holding stocks for decades, and he's owning, say, Coca-Cola, well, you can put Coca-Cola in there, and that's going to help you sort of define his portfolio and you can hold it. Problem is, if you have a strategy with higher turnover, there's only so much data you can use. You got to look at more recent returns. And from a data perspective, there's thousands of potential stocks. Now, Warren Buffett's a weird example because Berkshire also has private holdings. Ignoring that, though, this is sort of the top-down approach. The bottom-up approach would say, well, instead of trying to figure out what stocks he owns, let's try to figure out his actual strategy. What are the characteristics he looks for? How does he pick stocks? And if we can identify his process, then we can just try to use that process on a go-forward basis, and that should track his returns. So that's sort of what I would call a bottom-up approach. And as long as he doesn't have meaningful style drift over time, you can look at a lot longer of his history. So this is exactly what like factor-based replication is. There's a great paper from AQR called Buffett's Alpha, where they found that by and large, you can replicate a huge portion of Buffett's track record by saying, hey, just by, high quality, low vol, safe companies, profitable companies, and lever them up 1.3 times, right? And if you just do that process on your own, you get a return stream that's very similar to Buffett. Does not take away from Buffett's Alpha, by the way, because, being 2015 and figuring out what Buffett was doing back in the 1970s is very different, right? Like that's all with the benefit of hindsight. But if you're trying to replicate it going forward, my broad point in doing all this was just that, hey, here's two ways to think about replication, right? DBMF, the Managed Futures ETF from our friend Andrew Beer, takes this top-down approach where they're trying to look at recent returns of the SocGen CTA index and figure out what futures to hold and how much of those futures weight, positive or negative, to replicate those recent returns. It's a top-down approach. For whatever reason, people were like, well, no, you can't replicate Warren Buffett, or no, you should look at his 13F, or no, his returns have changed over time. I was like, you guys are completely missing the forest for the trees here. Like none of this was about Warren Buffett. It was just about, that was an example of replication. I don't know. Maybe I just need a timeout from Twitter, man.
I wish I would have taken notes on that because I have like at least 2 or 3 things to say, and I can never remember more than 1 or 2. But do you remember? You would know better than I would. Was it 1.3x leverage or was it 1.6? I think I misremember as like 1.6, but I know you tweeted 1.3, like leveraging up low vol. But that's irrelevant.
I think it was 1.3. I pulled it out of my ass though. That was like from me remembering the paper. It might be 1.6. Yeah. Either way, it's a decent amount of leverage.
Yeah. So we had this argument at one of my dinners in Miami where we were at the end, one end of the table. We were talking about alpha. Does alpha exist? All those sorts of things. And one of the ones, shout out to Bastian Ballesta in Switzerland, one of our quant managers, was talking about, well, alpha is just a factor that hasn't been found yet. And it reminds me of what you said about Buffett is like, yeah, it's one thing, to look at Buffett and replicating, low vol stocks with leverage, but he figured that out before there was such a thing as like high quality, low vol stocks. And it's easy to talk about it now, but like, what are you doing in the 70s and 80s? Right. And so you're front running those factors.
Yeah. There's this idea of the shrinking alpha, right? Which is like back in the day before we had these defined risk factors, it was like anything that wasn't the market return, if it was positive excess returns, was alpha. And then you get to like the Fama French 3-factor model. And you say, well, if it's value and size, and we know that those explain a decent amount of the cross-section of returns, if you're just doing that, is that alpha anymore? Like that's an explained factor. Well, now the residual above that, the 3 factors is alpha. And then you get momentum and quality and anti-beta in the mix. And the more and more of these that you're able to sort of systematically define as powerful explanatory variables, the more the excess returns are explained. Is it alpha anymore if you know what it is? Some people would argue no. Once you can explain alpha, it disappears. I will point out, again, where does this term alpha come from? It's just from a linear regression, right? Your loadings in a linear regressions are called your betas, and then the leftover intercept term is alpha. So by definition, it is from how the actual the actual regression is run, whatever is unexplained, that's a positive term in the intercept. That's alpha, technically, mathematically. Is that what we mean as an industry when we talk about alpha? I don't know. I don't care anymore. Honestly, I just don't care. I've just hit a point in my career that I'm like, someone else argue as to whether it's alpha or not. Did it give me the returns I want? Great.
Exactly. That's how I felt at the dinner. And by the way, I could tell in the tone of your voice how much you don't care anymore. And I was just also laughing as like two betas describing alpha. But also Rodrigo confirmed that my asshole antenna is better than yours. Is he said it's 1.6 levered. So pulling it out of the ass, I guess my ass is a little bit better than yours today.
Everyone thinks you have a better ass than me.
Yeah. So going back to two different. Well, I had one interstitial question for you. My partner Taylor was at an EQD event in Austin yesterday, and they had some QIS people and everything, speaking on stage and saying regressing, different managers' returns to factors, etc. Do you think that only really works with single equity managers and everything? How do you regress returns if you start getting into all the esoteric asset classes or alternatives, even though you and I don't think of them as alternatives? Can you regress those, or does the factor model only work on equity managers?
Can you give me an example of what you mean by the alternatives?
Well, one, you could have some regression, obviously, analysis for commodities, but you start talking about volatility, long volatility, tail risk. There's no real data.
I think it starts to get really weird. I mean, obviously, it's hard when you're talking about illiquid stuff, right? Where your mark to market isn't clean. You're getting these weird vol dampening effects. I think that's very hard. Though you do see hey, maybe PE is just levered small caps, right? If you look at certain snapshots. So people have tried that. I think equity long short, trend following all sort of lend themselves to replication. I'm not sure something like distressed or relative value are easily explained necessarily. You have to make sure you have the appropriate risk factors already described to figure out how you can replicate this stuff. But I mean, the more idiosyncratic something is, both in the decisions the manager's making or the nature of the asset class, I just think you're talking about you can't replicate it.
Yeah, I think we need to work on a paper that's combining betas equals omega or something. We need to have it's the end all be all.
The two betas make an alpha.
Two betas make omega.
Tyler, this is definitely the name of the episode.
Man. So I want to tie this back. So going back to the paper, because you were talking about the two different ways of looking at Buffett's returns. But by the way, I want to start with something.
This is not a show about finance. What are we doing?
What did I do to offend you? Back in the day, you used to send me your papers and have to proofread them and give my thoughts and everything. And I think now you either don't care about my opinion, or you think you could just replicate my opinion. I'm just going to regurgitate so you're inside my mind. But either way, I'm offended because you didn't send me this momentum paper on crypto assets. You also didn't pre-send me your rebalancing timing luck on options. So I just want to know what's going on. What did I do?
I'm trying.
How did I hurt you?
No, it's not so much that. You remain dear to my heart. Listen, I know you better now. I'm trying to curate what I send you, right? I'm trying to be a good friend and only really send you things you'd be interested in. I don't want to waste your time. I know how much stuff you have to consume each week. You know, you've got information coming at you left and right. I only want to make sure I send the best things to you.
Nice.
And I'm not saying this wasn't my best work, because I think all my work is my best work. But but I just didn't think it would be like the best use of your time. It's stuff you know already. I don't think it would really enhance your understanding. That said, can I tell you kind of a little funny story about one of the papers?
Please.
So we talked about this rebalance timing luck paper that I wrote in collaboration with NDVR. Roni Israeloff, AQR, was one of the authors with me. Endeavor. Yes, thank you. Endeavor. NDVR.
Helps me remember it. Helps me remember it.
That's way better. So we decided to submit it to the Journal of Alternative Investments because the paper is about rebalance timing luck and options. Two funny things. One, Roni completely forgot he was on the board of editors. So he submits it and then is like, oh, I'm an editor in this publication. So that was kind of funny. But two, I then do a tweet at one point about some rebalance timing luck stuff. And the main editor of the Journal of Alternative Investments was like, you'd be surprised at how large this is in option strategies. We have a paper coming out about it soon. And I was like, you mean the paper I wrote? And this was like before they had told us they had approved our paper. He's like, I don't know. We anonymize all the papers. Maybe it's yours. Maybe it's not. And I was like, what a weird world. So I got a guy quoting my own paper back to me.
But for a second, did you think there was somebody else out there that's talking about rebalancing timing luck?
No, there's no one else out there. Though it's actually funny you say that. Someone reached out to one of my senior quants, Steven, in Europe, and they were talking about how like they're working on a rebalance timing luck paper. And I was like, whoa. I thought I very clearly defined this as my lane and my lane alone. This is my legacy to the industry. So we'll see. If they write a paper and don't cite me, shot through the heart.
That's when you know it's finally made the big time, when everybody starts talking about rebalancing timing luck and they don't cite you. But you were talking about two ways to look at Buffett. So on the podcast and in the paper about crypto momentum, one of the things I wanted to bring up was cross-sectional momentum. I would think, a lot of our audience understands that, but can you tell the difference or define the difference between like cross-sectional momentum and just like regular trend following momentum?
Yeah, so both of them look at prior returns. Trend following is the idea that positive or negative returns in an asset are predictive of that individual asset's future returns. So if an asset has historically exhibited positive returns, we think it'll continue to exhibit positive returns over the short term. And if it has negative returns, it will continue to exhibit negative returns. So it's on an absolute basis relative to itself. Cross-sectional momentum basically says if an asset is outperforming its peers, we think it'll continue to outperform. If it's underperforming its peers, we think it'll continue to underperform. It says nothing about the direction, positive or negative, right? All those assets could be going down. If it's relatively outperforming, we just think it'll go down not as fast, right? So they're both looking at prior returns, but one's self-referential and one's in reference to a peer group.
What's the literature? It's cross-sectional and then it's time momentum. I can't remember what you call it for the asset.
Momentum.
Time series momentum. Yeah, I just wanted to get that right. But I thought it was interesting because you guys were talking about cross-sectional on there. And then at the very end, you talked about overlaying time series with cross-sectional. And two things. I was like, I wonder how many people really get into cross-sectional versus time series and understand the difference, but also why you'd actually want to do both. I mean, you guys eloquently talked about it in there, but like maybe you could hit on that a little bit.
Well, in crypto in particular, now that the derivatives markets like FTX are gone and like it's a lot harder to trade derivatives. One of the interesting things about cross-sectional momentum is you can sort of argue the ability to efficiently short these markets has disappeared. Shorting has always been pretty hard in crypto without the perpetual futures and all that sort of stuff. There's a couple protocols that effectively let you borrow and then you could sell, which is in essence what a short sale is. but it's not super prevalent. And when you go back to like efficient market theory, you need prevalent shorting. If you remove shorting from markets, it historically makes them more volatile, right? The thing about shorts is they become natural buyers in a sell-off. If someone's short and the market starts to sell off, they make money, they become a natural buyer. It's a stabilizing force. Similarly, when the market's too hot, people will short, it can push the market back down. I don't want to say China's markets are a good example of what happens when you ban shorting, but historically banning shorting makes a market less efficient. Or if there's just no real easy way to short, you would expect a market to be less efficient. You would expect more of this bubbly behavior. So why is that important? One, I think it helps some of these momentum effects persist because people can only really be long or out. Two, it actually makes this sort of cross-sectional analysis harder because in traditional finance, we would look at being long the best recent performers and short the worst recent performers, right? Long the winners, short the losers. You can't really do that in crypto, right? So you're sort of comparing these different cohorts in the performance, but it's not as easy to express this long short trade, especially since like on spot tokens, trying to find what the borrowing costs are is hard. And some of them you might not even be able to borrow, especially in like the fat tail of coins. So long story short, it's one of the interesting things of like why we think both relative momentum and time series momentum possibly persist, because the structural makeup of this market, we don't expect there to be efficiency beyond the fact of like, what the fuck is actual value mean in crypto? Like, what is the tie to value? I don't know. That's another part of the thesis. Anyway, so then you go, okay, if you expect not only relative momentum to work, but potentially time series momentum, well, is there a way to create a better risk-adjusted portfolio by being long the market when there's positive trends, and then in particular buy those things that are outperforming, and then just be out of the market when there's negative trends? The risk here, there's a very subtle assumption here, and it's that the relative momentum strategy, its excess returns that you're hoping to achieve are not conditional on positive or negative market trends. Or even better, that strategy does better when the market has a positive trend and doesn't do as well when the market has a negative trend. What would be a nightmare is if that strategy actually underperforms when the market is positively trending and outperforms when the market's negatively trending. Like you have a backwards conditional. So anyway, long story short, we were just trying to create an interesting risk-adjusted return that you could try to generate some alpha and manage the drawdown simultaneously. But there's a lot of interesting subtle nuances to how you think about combining those things.
Yeah, this is why those are one of the highlights I want to pull out of there is like, especially you guys even highlight with crypto with the volatility or variance that if you do cross-sectional momentum, the drawdown's like in that 70-ish% range. Yeah. And that's why you need to overlay the time series momentum on there to manage those drawdowns. And then the other way would you look at it that I don't think you guys talked about is like, there's a lot of, there's high correlation in the crypto market. So that's also why you want that time series momentum overlay, because, especially in, liquidity events or liquidity cascades, if you will, TM, is that you're going to, you want that overlay because the whole market can go down together.
Yeah. I mean, historically, at least, first, let's acknowledge there's like no data here.
Exactly.
Right? You're talking about like 2 cycles that are 5 years. Anyone can launch any token at any time. Like this is like a lot of garbage data. And from a statistical significance perspective, it's like very questionable. There's a lot of, to me, this is where you have to marry the art and the science and going like, do I think these are the conditions under which this should work? What you found in the last cycle was the dramatic amount of leverage and credit in the system led to what were called liquidation cascades. Some people thought larger hedge funds were actually hunting for these, where they would figure out where people were over positioned, drive the market to a point where those would start to liquidate, and that would create this liquidation cascade effect. As people are force liquidated, it would drive prices down further, and you would get tens to hundreds of millions of dollars of people being liquidated within hours, moving prices considerably. So if you were short at the top, you could basically have everyone else force drive the price down. This is the same thing you see in traditional finance markets during extreme crowding and forced liquidations. Like the quant quake of 2007 was exactly this. I think we just saw a microcosm of this February. in some of the quant equity strategies. But I think crypto, I mean, this was like market wide. So yeah, it's just managing risk seems prudent.
Got it. Before I get to the other highlights from the Med Paper podcast, do you know what it's time for, Corey? It's time for our Pirates Pinky Promise. Now, Corey and I, surprisingly, don't make a living from this podcast. We actually do it because we work for you. On Fridays, we try to provide some mildly entertaining content for you. So as a Pirate Pinky Promise between us and you, I think you need to subscribe to the show. You know, most of you out there are not subscribed.
I just realized
to the show.
what you're doing.
Yeah.
The Pirate Pinky Promise. Is that what we're calling it? The Pirate Pinky Promise?
Yes. Yes. We're in this together. You know, Booty Crew, we hear you, but a lot of the Booty Crew is not subscribed. We need you to like,
betas definitely
subscribe.
don't make an alpha with the Pirate Pinky Promise.
But also, this interlude in the show is sponsored by Liquid Death. You know, the favorite, you know, water of pirates worldwide. You like even that when I show that, it's still blurred out. That's how much
our sponsors aren't going to be happy about that.
The sponsors are going to be. So back to the show, if you will. But, you know, like, subscribe, share with another fellow pirate. We need to increase this Booty Crew, the world famous Booty Crew. But going back to the episode, some of the other highlights that I thought were interesting, just to pull them out, is one of the things you mentioned. I don't think I've heard before, but it was the rational inattention hypothesis.
Yeah.
For trend. I don't know if I've ever heard it put that way. So what's rational inattention?
So the idea of rational inattention. So trend following is kind of like this really simple anomaly, right? When you think about it, it's kind of dumb, stupid. It's like, okay, price went up, so we think price is going to keep going up. Like, okay, you idiot. There's no way that works. And yet somehow it seems to. So there's all sorts of arguments as to what are the behavioral anomalies that lead to this. That basically price discovery is not instantaneous. There's anchoring biases, there's herding effects. One of the arguments is this idea of rational inattention. There's a really cool paper that I'll get to in a moment that talked about this. But basically, you only have so many hours in the day, Jason, and there's only so much information you can take in. And it is entirely rational as a human being to only pay attention to certain things and ignore other things, which means by definition, at least according to this argument, that price discovery is not instantaneous because people are going to learn the information and adjust their positions accordingly over time, right? So if you learn the information first, you might get a jump on other people, but that can lead to changing price pressure on the supply and demand side, which can lead to the creation of trends, which can cause people to suddenly pay attention and make trends persist as they adjust their positioning. But the basic idea is like, it's not irrational. You're just time constrained. And so it's rational to only consider certain information at certain times. There was a paper, I'm blanking on the name of it, where the authors basically found that stocks that were more likely to catch attention were like persisted more in the momentum anomaly than others. And I think they looked at both chart patterns as well as like just being outliers in performance. I'll have to go back and read the exact paper. It's been a couple of years since I've read it, but pretty fascinating approach to just basically saying like, yeah, we're time constrained.
Yeah, or like that's why it jumped out at me when you said it, because it's a elegant way of basically saying that like we notice things that catch headlines. Like, so if you're like Tesla's making new highs, you're like, oh shit, I need to jump on Tesla. Otherwise, you wouldn't have probably even thought about buying into Tesla. Is that?
And that's exactly the idea. That's exactly the idea.
So then two other small kind of things in there too that I thought were interesting was, you know, Meb started asking, you know, what about creating some like market cap weighted indexes around crypto? And Lee really brought it up too. It's like, what market cap? We can't even agree on a market cap for any of the crypto tokens. And that's just interesting to think about, is like, there's no actual market cap that everybody agrees on.
Yeah. And up until recently, I mean, this sounds kind of wild, but like 2 years ago, you couldn't even agree what the price was. Right? It's so many venues trading Bitcoin that, and the arbitrage mechanisms, right? You're operating not on the wall clock, you're operating on block time. How fast can you move money across the blockchain that you could have meaningful price differences that could persist for a while? Now, as more and more institutions and more money, sophisticated money comes in, that arbitrage has gone away. But yeah, I mean, you know, price being an important component to market cap, and then there's all sorts of other ways of issues of measuring it. But yeah, it's a non-trivial question for people coming from traditional finance. Like, what is market cap?
And you just brought up arbitrage. So speaking of non-arbitrage conditions, one of the other little highlights I want to bring up was you talked about trading costs, and you're talking about capping those trading costs. And we both know, and like a lot of crypto traders and everything, it's almost like, fishing or golfing stories. They exaggerate their gains and they don't talk about their trading costs. And so part of the paper, remind me of what you said you need to cap your trading costs are, which is actually pretty difficult if you're trading crypto.
I believe for us to continue to have, for momentum to have a persistent edge over the benchmark, which was Bitcoin, you need 50 basis point trading costs. What I want to say though, excuse me, is like using
Did you drink
Bitcoin,
milk again?
Yeah, I was chugging milk before this episode. Using Bitcoin as a benchmark for this study, like there's a bit of a survivorship bias there. Like we're choosing Bitcoin because everyone benchmarks to Bitcoin, but everyone benchmarks to Bitcoin because Bitcoin did well historically. Like if you look at it compared to other tokens, its performance is like in the 90th percentile. So you're already starting choosing a token that massively outperformed the other tokens on average, which means your trading strategy has to make up a huge amount of ground just to get to the benchmark. So if you were to say, no, my benchmark is sort of this equal weight portfolio of all the tokens that are out there that I could have selected, you have much more width in your T costs. And so, right, if you think Bitcoin will continue to be a 90 percentile token in returns, okay, great. Then it questions whether you should even do this type of strategy because the T costs, like 50 bips might sound like you could drive a truck through that in traditional finance. I mean, unless you're doing institutional level size in crypto, the T costs are pretty high, and your impact's very real. So, you sort of need to question, like, are you going to play the benchmark gaming game where you choose a benchmark that you look better compared to? But if Bitcoin all of a sudden became like a 20th percentile coin of returns over the next 5 years, well, your strategy has just a lot more breadth to outperform from a T cost perspective.
Speaking of that, apparently Rodrigo hated that Pirates pinky promise. He said he's unsubbing because of that. But part of that is, let's be honest about Pirates pinky promise, is the Booty Crew. We have the best comments in the game in Booty Crew.
I can't even read the comments in real time anymore.
I'm glad you're not looking at it,
because it makes it impossible for me to actually focus on the show. I'm laughing too hard.
Right. And it's always hard to pick a winner because it's impossible. But Bacon Memes also just said, when we were talking about market cap, he said, as the kids might say, capping on market cap. I just thought that's right up there for today's comments.
I still don't know how to use cap and no cap correctly. I've given up trying to learn.
Just too old. The last thing I want to talk about in the podcast, it was slightly tangential, but I was listening to another podcast this week that made me think about it, was CEFs, closed-end funds. So you guys started talking a little bit, obviously, about like the Bitcoin or Ethereum closed-end funds. But I was listening to another podcast, and they were just, I don't no shade on anybody, but it was all about CEFs, and this person is a CEF investor, and was just, as we're always shocked by on social media, how some people can promise like crazy returns and gains and say all that stuff, is like, they were just basically pointing out that they think it's easy. It's at a discount to NAV. You just buy the closed-end fund, it closes to NAV, goes to a premium, and then you sell out then. And then in the meantime, you make yield on it. And I was just like, man, that is like grossly unnuanced. So, yes. I mean, right now, like, I think what is the Bitcoin CEF is like trading at 50% discount to NAV. But the question is, will it ever close that? And is it there for a reason? And then people don't even understand the mechanics behind it. There was large hedge funds that were just pumping money into the on the backside, because then they could just hold it for 6 months and then release into the market. And that's how you start seeing divergence from NAV. So like, you got to think about other mechanics that are involved, not that it's just going to close to NAV because it should or has to, or that's behavioral.
All right. I think, again, this goes back to my theory, or my thesis, my null hypothesis, that just assume markets are efficient. Like, just start there, right? If you see something trading at a 20% discount to NAV, you really have to ask yourself, like, why am I finding the free money on the street? And that doesn't mean that the free money's not there, right? But like, why is the rest of the world willing to let this thing trade at 80 cents on the dollar? Like, because I generally presume I'm not that smart, right? There's a lot of very savvy, sophisticated people who are out looking at all the same things in the market I'm looking at. Like, if it's this super obvious trade, why hasn't someone else taken it, or why hasn't way more money taken it? So I think that was largely the case with the GBTC closed-end fund, where it's like it was down 20% discount to NAV, and then 30, and then 40, and then 50, and it's like, well, there's got to be some hair on that, right? Or else some hedge fund would figure out how to buy that and capital efficient short Bitcoin, and you're basically locking in the return difference of 50%. And who wouldn't take that?
Yeah, I just thought it was just in this other one I was listening to, it's like oversimplification that was just making me angry. That like, yeah, you buy at discount, it closes, go to a premium, then you sell. And it's also like, so it's like market timing, yield till it comes there, and then just saying you can make unbelievable returns doing that. And so maybe you don't need to save as much for retirement. I was like, what? Excuse me?
And I do know people who do that. Jake, Econompic on Twitter, has done that a number of times. But his general argument is like he looks for that stuff during market dislocations.
Yeah.
He thinks those levered strategies, people tend to wash out of them during market dislocations. They tend to trade at way too steep a discount. And he takes a bet, right, that he's going to buy those, and they're not only going to bounce back, but they're going to really collapse that discount to NAV and potentially even go back to a premium. But again, you have to ask yourself, like, why? Why is it trading that way? And it's supply and demand, right? I mean, you saw this the other way with ETNs that closed issuance, with like the Barclays ETNs, their notes that were closed issuance last, was it 2022, early 2022? Yep. They started trading at a significant premium because so many people wanted them and they couldn't issue new notes that people were willing to buy well above NAV. And that's sort of a game of hot potato potentially, because the second they begin to reissue, you're going to have it collapse to NAV. On the other hand, if you're trying to short it, assuming that collapse to NAV, it's a question of what are you paying on the shorts? So it's not always easy to trade that stuff. And there's normally a good reason why it's trading at a premium or a discount.
Yeah, and I'm no problem with like Jake trying to do like the event stuff, especially in like a March 2020 like scenario. And I think Homie Meb always brings up like Bill Ackman's closed-end fund, right, in March 2020. Like the people that were paying attention, that knew about all of the hedge positions he had on, it was a tremendous opportunity. But once again, you're still running timing risk, no matter how deep you are in the weeds and how much you think you're taking advantage of those behavioral, problems during those times.
You ever thought about running a closed-end fund?
Yes and no. I do think like an open-end interval mutual fund is a better version than a closed-end fund. The hard part is, here's what you and I both know, it's like Bill Ackman and others can raise billions of dollars to initially set up the closed-end fund. I'm a little dubious of my ability to raise that much money to start
the roadshow IPO.
Yeah, that's not our bag. Like, we didn't come from that world, and I just don't see us putting that together. So I think that's always kind of precluded me from even thinking about that, because yeah, you need to raise the assets first to even set up a closed-end fund. I
agree with the open-end interval fund. You kind of get the benefits of all of it.
Yeah.
I mean, the crazy thing about the interval funds for me, whenever I talk to someone who buys them, they're like, no, I can exit. I'm like, no, you can't. Like, they can literally drag this out for in most of those terms, it's like they could give you 1/10 of your money back every quarter. Like, it's you got to really read the terms to understand how gated you could be and how stuck in those positions you could be over time.
Man, shout out to Rod, because I think he even tweeted about, and I might butcher this, that he was talking to a Canadian pension or something of the sort, and they were talking about alternatives, and he's like, well, I'm in credit funds, and that's what he saw as alternatives, and he was like, because he's like, I like liquidity or something, or I don't like illiquidity. And then it's like, how's your credit funds now? He's like, oh, I can't get my money out. These things are shit. Like, I'm never doing alternatives again. So it's like multiple layers, and I just butchered that, but like maybe you remember a little bit better. But it was, once again, yeah, like the money's not there when you need it most. I mean, that's everybody's worried about liquidity when times are good, but it's about your exit liquidity, and is it going to be there?
Have you been keeping your eye on like pension mandates at all lately?
Not closely.
They do like well, so there's these portals that if you're an asset manager, you can typically get access to, that a lot of pensions put out RFPs, requests for product. So you can actually go see what they're asking for. I've been kind of surprised lately. There's been a decent amount of demand still for like CTA. And I just saw one come across my desk that was looking for a gold overlay. And I thought that was kind of funny. I'm like, why do you need to hire a manager to do a gold overlay for you? Like, this was like a big institution. It sort of surprised me that they just didn't have an in-house desk that could buy gold futures. Little weird. Still a decent amount of demand for tail hedging, which I thought was interesting. I've been
you're talking about, like, I know EQD is like trying to launch a marketplace for like RFPs and stuff. Is that kind of
they've got one called Mandate Connect. There's a whole bunch of them out there that you can go and you get notice. And then you can go do the RFP process. It is a dog. I've done that before. Not for me. There are people whose job it is just to fill out those RFPs full time, and hopefully you have compliance approved verbiage to do that stuff, because it's a beast.
No. Well, that, and I would almost think, do you think it is a contrary indicator? Like, whatever the pension funds are RFPing about, you're like,
don't say too little to me right now. Don't say that to me right now. It is that too little too late thing is like, again, talking to a ton of advisors, it's like a lot of paralysis right now. The beginning of like January was so good. Advisors are once again paralyzed from doing anything. They're like, I don't want to make changes to my 60/40. I'm afraid that we have figured out not just like, there's not even a soft landing. There's no landing now. We went from hard landing versus soft to no landing. We're just going to keep flying, I guess. And they're like, we don't want to make any changes. Don't want to add alternatives. Yeah, it's an interesting. I mean, I've had more conversations about people talking about exiting their managed futures to add bonds than I've heard people talking about selling traditional stuff to buy alternatives.
Yeah, whether it's in Miami or Austin the last few days, some of the feedback has been like, I talked to some large endowments that had like tail risk, but it was such a de minimis amount that it didn't really help their book that much. I mean, it did what it's supposed to do, but it didn't help them because of allocation size. And similarly with CTAs, they're like, oh, it's a great year for CTAs, but it's like we only allocate like 3 to 5%. So it's like not moving the needle. And then we were talking about,
and again, it all depends on the vol. Like 3 to 5% at a 30-40 vol product can actually move the needle, but they never do. They buy the 10 vol product.
No. It's single digit vol. You and I both know they're trying to keep their seats, so it's always single digit vol. So it's even worse than in that scenario. And then like somebody I was talking to the other day is like the endless debates they used to have about just allocating 50 bips to 100 bips more from like 3 to 4 or like whatever it is. It's just
I'll tell you the term of the week for me. This one came from Scott Rubner at Goldman Sachs. Is JOMO. So FOMO is the fear of missing out. JOMO is the joy of missing out.
Right. Yeah.
That you can now sit in cash and earn 4.5 to 5%. Who cares? Why take risk? Especially, I got to tell you, the scariest chart I've seen lately is you look at like what the 6-month T-bill rate is. I think it's like close to 5% right now. And then you look at that versus like forward 12-month earnings yield on the S&P, and it's like the tightest it's been since 2000. And you sit there, and I remember looking at all the charts being like, if I was investing in 2000, I would have owned treasuries. Why would I own stocks? The yield versus this doesn't make any sense. And now I'm sitting here, I'm like, oh God, this decision isn't as easy as I thought it was.
Yeah. I mean, it's obviously anecdotal and it's obvious, but like I was quoted on a loan the other day. It was like SOFR plus, whatever margin they had over. And I was just like, it's amazing how a few years ago, you're just basically writing SOFR at 0. And now it's at 4.55. And then so that spread over SOFR starts to add up. I mean, it's just where SOFR's at. Rodrigo asked, did you guys see how Asness went to town on FT in defense of private assets article? I haven't seen that yet. So I just wondered if you have.
Missed that.
So glad I read that one, seeing how we have no comment.
No comment. I listened to a good interview with him in The Economist. They did an interview with him. It was very vanilla. There was no tremendous insights if you follow his work, but it was, he always does a good job of like humanizing the quant, in my opinion.
So I told you I had a few surprises for you. Another one is when we were in Miami in our last podcast, the greatest podcast ever recorded that will never see the light of day, we did try 4 new rum samples. And there was one we actually really liked, where previously we had tried 6 to 8 samples and we didn't like a single one of them. Is that correct? And then so the latest one, I just got the information back before we came on. So here was the blend. You ready for this?
I'm ready. Is it 8? Tell me it's just what we wanted. Like
it's an 8-year-old Dominican Republic, a 3-year-old Venezuelan pot still, a 2 to 8 year old blend of Venezuelan rum, a 6-year-old Panamanian rum, and a 3-year-old Dominican rum.
That is
so
that's interesting. That's a wider breadth than I would have expected them to mix together.
Yeah, you got 2 Venezuelans, 2 Dominican Republics, and Panamanian, and anywhere from 2 to 8 years, and they even throw some little pot still in there as well. Or I don't know if they're all pot still or column still. I just saw one of them was represented as pot still, because I know we asked for a blend of pot and column, didn't we, last time? I think.
Yes, we did.
But it was a blend that both of us thoroughly enjoyed. That's why it was the greatest podcast ever recorded.
Yeah, because we kept drinking it.
But it was, I mean, it's tiny. It was like 2-ounce samples or something.
Listen, after a week of going out every night, the shampoo effect, it doesn't take much to get me going.
Dude, you got to I'm so glad you brought this up. I never heard shampoo effect, so now you got to tell the booty crew about the shampoo effect.
This makes me feel like such a frat boy talking about this. I hate. Okay, all right. What is the shampoo effect? This is where we're really getting off.
Not a frat boy. To me, it just shows that we're just 2 old boomers that can't handle any drinking anymore.
Yeah, this gets off the topic of finance quickly. So the shampoo effect. So the idea here is if you've ever washed your hair with shampoo and then forgotten or for whatever reason, and then washed your hair again, your hair gets really sudsy really quickly. And so the idea is that if you were ever drinking too much in excess, got a little drunk, and then sobered up, if you do it within a certain time frame and you drink a drink again, you'll be drunk again really quickly, even off just that one drink. And so in the certain circles I ran in college, that was called the shampoo effect. I think I assumed other people knew about it. Maybe not. Maybe a bunch of people my age, Jason. It was a younger term. You missed out. But actually, I think it was Amanda told me. I told her what the shampoo effect was, and she's like, "Actually, I know the science as to why that works in your hair." She's saying something about like when you initially shampoo, it's chemically designed to pull the dirt out first.
Yeah.
And then afterwards, it interacts with the water. So the second time around, it's only interacting with the water, so it gets way sudsier. And I was like, I didn't want to know the truth behind this. She's like, no, but that's actually true.
Do you see Tyler threw Rod's comment up there? Bro science is like, that's all we do. That's the best kind of science. Bro finance. That needs to be our new subtitle for it. Yeah, bro. The other thing though, we did cheers to on the last podcast, and I owe you a mazel tov. But like this is also something that I would assume once again we can't talk about. But you launched an ETF, so congratulations.
Thank you.
Can we not talk about it? Will we ever be able to talk about it?
You know, probably not.
I was going to joke about like return stacking and the thing we'll get to next podcast, but I really learning about this world from you is like it's crazy that you literally can never talk about it. And I'm not going to name the name because I can't even, it shall remain nameless.
If you ask me about it, I can probably talk about it. I can probably say it actually. But it means I can never share this episode ever without it going through compliance.
I did ask you before. You told me, because I do have one question I haven't asked you about privately, is we were talking about the stuff you create on the website, and you were saying how you designed a lot of it because I thought it was well designed. The email you guys sent out, there's some cool graphics for it. Who designed those graphics?
Shout out to Emmy at Resolve. Rodrigo works with this awesome graphic designer, Emmy, who we were like, we need some graphics. And within 20 minutes, just bam, came right out. So
I liked it.
Yeah, they were phenomenal looking. And then we sent them to compliance. They're like, no, you're gonna have to add disclosures. So because we put the word diversification in the image, we had to have a disclosure that diversification does not mean you won't lose money. I was like, okay, this is outrageous.
Dude, Booty Crew coming in with a thunder right at the close. Sean Weiland said, plot twist, Corey named his ETF after his child. That'd be good. Oh. And I can only think in my head because I can't say what the name of it is. Then that's why it's so good too. When I was even thinking about the image and the design, I wanted to say the name of it because it looks so good in the way it's designed, but I can't even say the name of it. This is crazy.
Maybe someone in the Booty Crew can just throw it in the chat.
No, it's fine. Anything else? I think we're running up against time. If you want to take us out of here, give the disclaimer. Let's get disclaimers all around.
No,
even though we don't talk about finance.
I know. I do want to say you did a really good job this episode of just making sure I talk the whole time.
Always.
Well done.
It didn't do a good enough job, because if you notice, that's the whole point. Like, you shouldn't notice that you're doing.
Don't think I didn't notice. Don't think this won't come back around to you. Well, listen, everyone, thank you for joining. Thank you for listening once again. Listen, please take the pirate pinky promise. We appreciate your likes, your comments, sharing. We do this for free out of just the love of talking to each other, talking about these things, chatting it up with the Booty crew, talking on Twitter. It's always fun for us. So thank you for joining us. Once again, none of this is financial advice. And that's it. The last thing I will say, Jason, is my wife is due like any day. So we got to like pre-record 15 of these in the next, I don't know.
No,
2 days.
I want tired ass Corey on here
just so I can get through. All right. Well, that
Tyler,
is it. And with that, Tyler, take us out.